Yesterday's historic sell-off sending shivers through an already fearful market. Our next guest may or may not help because it's called the Gloom, Doom, and Boom report. So there are booms there once in a while. Joining us is Marc Faber, editor and publisher of the aforementioned report. Great to have you, Marc. And we'd be remiss. Let's immediately start with Southern Europe, Greece, and what's happening there.
Well, basically, we have a financial crisis in Greece, no doubt. The country is basically bankrupt, and the EU will most likely have to bail it out. And obviously, that's favorable for Greece if they get bailed out, temporary, but negative for the EU. And so the euro was weak over the last couple of weeks. So that is basically what has happened. Now, it's not that Greece produced the market sell-off. It was a trigger, a catalyst for the sell-off. There were lots of factors playing into a correction to start with. The market was overbought. We were ahead of essentially economic fundamentals. In emerging economies and around the world, we were up more than 100% from the March 2009 lows, and in the U.S., 80%. And very clearly, the economic expansion, particularly in the Western world, Western Europe and the U.S., considering the huge fiscal stimulus and zero interest rates, has been rather muted and disappointing.
Do you think that it's possible to bail out Greece effectively and that it's not kicking the can down the road? And then how far does the contagion spread to other countries in Europe?
Well, I think that most Western European governments, with few exceptions, and the U.S. in the long run cannot pay their unfunded liabilities. And therefore, we will have more and more sovereign defaults in the future. But of course, we live in the 21st century, and when we live in this century, the governments, they print money before they default. And that will be the case in the EU, and it will be the case in the U.S. So temporarily, you can postpone the hour of truth.
Marc, about the hour of truth, the bond vigilantes have woken up in Greece, in Spain, in Portugal, in the UK, in Ireland, in Iceland. When do you think they're going to wake up in Japan or United States? We're worrying about Greece, but the U.S. budget deficit this year is going to be around 11%, close to the Greek one. And our public debt is going to double as a share of GDP, and that doesn't include unfunding the liabilities at the local level and at the government level. So when will the market realize that fiscal policy in the U.S. is also unsustainable?
Well, could I just come in there?
Sure, that is a big question. I don't think they've woken up yet to that fact, because the U.S., it's not that the U.S. dollar is strong because there is anything favorable in the fundamentals of the U.S. dollar. It's just less bad than the others. So on this Greek crisis, the U.S. bond market rallied because it's less bad than the other bond markets. But in the long run, the U.S. is facing precisely the same problems like Greece, with the exception that Greece cannot print money, whereas the U.S. can.
So exactly. What the U.S. has going for it is that things are much worse every place else. When things are really in crisis in the rest of the world, funds flow into the U.S. That's what's happening. And that's what's pushing our rates down at this point. So those capital flows are very positive for the U.S. So our time will come, but it's quite a ways off. We will have a crisis, but it's in the quite distant future compared to what's happening today.
Quite distant future means to you next year or 2012 or when?
No, I think it's difficult. First of all, we know that the real blow-up in the budget begins in 2030 and really takes hold in 2040. The markets aren't going to be that patient, no doubt about it. But the budget deficit is improving for the next 5 years or so. We're going from like 10 to sort of 5% under most forecasts.
Well,
so I don't
5% is still $100 billion, so it's almost $1 trillion.
But it's going, absolutely. Right? 5% is going to go way up from there, you know, over the course of the next couple of decades. So there's no question we're going to have a crisis. We're only debating about whether it's around the corner.
Will you get warning signs before this happens, or will it happen relatively quickly overnight?
No, there'll be a trigger. There'll be some trigger, but it'll come on us pretty quickly. I think. There's going to be a trigger. I can't tell you what that trigger is. But when it comes, there'll be a rush for the exit, the total loss of confidence in the U.S. economy, collapse of the dollar, soaring interest rates, collapsing equity values, and fiscal bipartisan agreement doing exactly what we know what they're going to do. They're going to pull it off a shelf. We all know what's going to happen. We just don't know whether it's going to happen proactively or after a crisis, and I picked the latter.
Why could it occur next year? We have state and local governments that are bankrupt. We have a federal budget deficit is huge. We have unfunded liability coming from Medicare and Social Security. We have unfunded liability at the level of state pension
so let me ask
problems.
You this.
All these things, maybe after the election with more divided government, going to imply that the market is realizing there's not going to be any fiscal consolidation for the next 3 years. We have election this year, we have election 2012. Why do we expect any?
So let me ask you this. Would you have expected that the financing needs for the U.S. would have not had any impact on 10-year rates today? Would you have believed
Well, in the short run, we have weak economic growth, deflation, bouts of risk aversion are bringing money to the U.S., the Fed on all the zero rates, QE,
I'm sorry.
other country accumulating reserves. All these factors are keeping yields low. The point is that at some point down the line, the market will realize our fiscal conditions are unsustainable. It's not going to happen this year, I agree with you.
That's true. The question that we disagree with is whether this is in the markets or not. I would say it's not in the 10-year rate at all now.
No,
the markets are complacent.
Yeah.
Okay? They're complacent in part for two reasons. One, if they think it's a long way off. And two, when we've had these situations before, never acute as this, we've always gotten fiscal action. This time, it's unlikely.
But take a bond market yield pickup to impose market discipline. Right now, you can borrow at 0 rate on the short hand and at 3.5 on the long end. Of course, there is no political incentive to do fiscal adjustment.
All right, hold on. We got Marc Faber on, probably from Thailand. Mark, the other thing I want to get to just quickly. You now are in the bear camp on China, or at least that the day of reckoning is upon us in terms of the property bubble?
I want to clarify my point of view about China very clearly.
Okay.
I believe a slowdown in the Chinese economy is coming regardless. Now, will it lead to a crash? We don't know, but it could. And we have a bubble in the property market, not in every city to the same extent, but in some sectors of the economy and in some regions of the country, we clearly have a bubble. And that bubble will have to be deflated at some point. And all I can say is the Chinese stock market is already down by 25% from the peak last August and by 20% from the peak in November. So it hasn't confirmed the whole advance that we had in Western markets and in the U.S. since the beginning of the year. Now, how bad the slowdown and the crash will be in China remains to be seen. All I can say, in the long run, I'm a believer in the Chinese economy, but rapidly growing economies like China can have huge setbacks on a 1 to 2 years basis.
Very good. All right. Thank you. We understand, Ms. Faber, and we'll check back with you and a more extended interview at some point in the near future, hopefully. See you later. Thanks.